So the Indian IT sector is kicking off its Q1 earnings season literally right now. TCS starts things off July 10th. Now, why should you really care about what's happening inside these, tech giants? Well, because their performance, it isn't just about their own balance sheets. It's actually a crucial barometer for global economic health, for tech trends. And maybe most importantly, right now, it's a real-time indicator of how AI is truly starting to impact businesses worldwide.
That's exactly right. And that's why we're doing this deep dive today. Our mission isn't just to report the numbers, but to really unpack the key factors analysts are watching closely. We're going to look at 5 critical themes, everything from revenue performance, those margin pressures we always talk about, to the real, still evolving impact of generative AI, and also those big shifts we're seeing in hiring. We've gone through the latest analyst notes, company insights, really trying to give you a clear picture of what's actually happening in this, incredibly dynamic industry.
Dynamic is definitely the word for it. I mean, this industry is navigating some pretty serious headwinds, right? You've got this continued sectoral slowdown, global trade tensions, wars still ongoing, and even worries like Trump's reciprocal tariffs possibly coming back. But here's the interesting thing, the paradox almost. Despite all that caution, the deal wins have actually been, surprisingly better than expected. It kind of raises this fundamental tension, doesn't it? How do you manage global economic uncertainty while also needing to invest aggressively in game-changing tech like AI?
It's absolutely a mixed bag, you're right. And that tension is palpable. Let's start with revenue growth trends, because that sets the scene. What's really striking is the muted expectation for the Tier I firms, the big guys. Analysts like Kotak Institutional Equities, for example, they're forecasting a sequential decline, maybe 1-2% in constant currency terms for these larger players. It's a clear sign clients are still being cautious with spending.
Okay, muted for the big players. But you mentioned a mixed bag. Is there a counter trend emerging somewhere else, like maybe in the midcaps? I heard Infosys and LTIMindtree are seen as relative outperformers among the large caps, maybe because of deal ramp-ups or acquisitions. But what about companies like PersistentSystems, Infosys, Coforge? Are they actually showing stronger growth?
Yeah, that's the interesting part.
Yeah.
Those midcaps, they are projected to show stronger sequential growth, somewhere in the 2-4% range. It really highlights where the current demand is, sort of concentrating. It seems fueled by pretty robust pipelines in specific areas, BFSI, banking, financial services, insurance, and healthcare too. These sectors seem to be pushing ahead with tech investments, showing some early recovery signs, whereas manufacturing and high tech still under considerable stress globally.
So a very patchy recovery then, sector by sector. And globally, didn't Accenture CEO Julie Sweet recently say that macroeconomic uncertainty is actually higher now than in 2024, with clients facing both economic and geopolitical risks at the same time? So given that kind of backdrop, what does this mean for India's biggest player, TCS? How are they expected to fare?
Yeah. For TCS, the expectation is for a sequential revenue decline. And that's significant for a company their size. Analysts are pointing specifically to the impact of the BSNL deal revenue tapering off. That was a big one. Just to give you an idea of the range, Kotak predicts maybe a 0.4% drop, BNP Paribas sees 1.3%, and ICICI Securities, a sharper 3.4% decline in constant currency. That variation shows you how sensitive even giants are to the life cycle of these huge contracts.
Right. So what are they doing about it?
Well, strategically, they're responding pretty actively. They're chasing new projects, both globally and within India. And interestingly, they recently launched sovereign AI offerings, basically AI infrastructure control within a nation's borders, plus cloud and cybersecurity, aimed at capturing government investments.
Okay, so feeling the pinch from past deals winding down, but actively pivoting to these newer, maybe higher growth areas like sovereign AI. That pivot's crucial, obviously, but it also brings up the question of the bottom line, margins. Because even if revenue growth is sluggish, how are these IT firms managing that delicate balancing act? They're juggling wage hikes, this weaker revenue, plus these significant ongoing investments in things like AI.
Yeah, it's a real tightrope walk. Kotak, for instance, they expect margin headwinds across most of the large caps. Infosys might hold steady, perhaps due to some operational efficiencies they've found. But for the mid caps, interestingly, there's potential for slight improvement in margins, driven by, operational leverage and maybe some currency tailwinds helping out. Guidance-wise, we expect Infosys to stick to its 20-22% EBIT margin range, and HCLTech probably around 18-19%.
And how's AI playing into this margin picture? Is it just a cost or is it helping?
Well, that's what's really insightful. Companies are leveraging AI internally to boost productivity. They're using it to rationalize delivery structures, optimize the span of control, basically making operations leaner. It's a direct countermeasure to the margin pressure. So AI is already impacting the cost side, not just the potential revenue side.
And for TCS specifically, are they facing similar margin pressures despite those strategic pivots we talked about?
Yes, they are. Look, the recent rupee depreciation and maybe some cross-currency benefits could give them a little boost, but that slow revenue growth, it's expected to largely offset any gains. BNP, for example, expects their EBIT margins to actually contract a bit, maybe to 23.9% from 24.2% last quarter. It just illustrates that challenge, right? The lack of leverage you get from growth when you're that big, even with deferring wage revisions, it's tough to squeeze out more profit without top-line growth.
Okay, so a squeeze on multiple fronts there. But
Yeah.
let's shift gears a bit because you mentioned earlier the demand outlook isn't all bad news. Despite all the uncertainties and the slowdown, you said the situation was maybe slightly better than analysts expected. What's driving that?
Yeah, that's kind of the silver lining everyone's watching. Analysts at places like BNP Paribas and HDFC Securities, they're indicating the demand environment has been, well, largely steady in recent months. BNP even connects this to global economic forecasts, suggesting, the U.S. economy might slow down, but probably avoid a full-blown recession. And Accenture's positive guidance for their Q4 FY25, pointing to improving pricing and client discussions moving from just focus to maybe leapfrog, that echoes this feeling and suggests clients are starting to think beyond just immediate cost cuts.
That is a more positive sign, especially with those macro challenges still out there. And does this steady demand outlook translate into actual deals? Is the pipeline holding up?
It seems so. The deal pipeline remains pretty robust, actually, especially in those core areas like cost optimization, infrastructure modernization, and increasingly AI initiatives. These seem to be non-negotiable investments for many businesses, even with things like potential U.S. tariffs or broader economic worries swirling around.
Do we have concrete examples? Like, what about TCS's deal flow?
Yeah, TCS is a good example of this resilience. Their deal wins have stayed remarkably steady. They're pegged somewhere between, say, $8 and $9 billion just for Q1. And it's not just renewals. It includes significant new stuff like AI, data analytics, digital innovation with Schneider Electric, Marathon de Paris, also platform modernization with ICICI Securities, Oman's Dhofar Insurance. They got an extension on that big BSNL deal for network maintenance, and even a digital transformation deal with Virgin Atlantic. So it's quite diverse.
Wow, 8 to 9 billion in this climate. That's still a significant number. It really shows tangible progress despite the slowdown.
Absolutely. It speaks to their ability to capture these varied opportunities.
And you mentioned AI deals in there. Obviously, generative AI, Gen AI is the huge buzzword. It's seen as this major growth lever, right? IT firms are doubling down on services, solutions, but is it translating into actual revenue yet? Or is it still mostly hype and pipeline?
Well, this is where it gets fascinating. There's definitely strong traction in Gen AI-led discussions and pipelines. Firms like TCS, Infosys, Wipro are all seeing this, according to BNP Paribas and Alara Securities. The conversations are happening. Clients are interested. However, and this is the key challenge, apart from maybe Accenture, and to some extent TCS starting to talk about it, most Indian IT firms haven't really quantified their Gen AI revenues yet. Clear interest, yes. But the measurable financial impact across the broader industry is still largely unquantified.
Okay, so the street, analysts and investors, they'll be listening really closely for any commentary on client adoption trends, proof of concept conversions actually turning into paid work, and any hints of early revenue impact from these services. But what's equally interesting, I think, is how Gen AI is starting to change the workforce itself. We hear about this shift from the old heavy-bottomed pyramid structure to something called a leaner hourglass. What does that actually mean for talent?
Precisely. That's a huge shift. As automation powered by AI starts handling more of the routine work at the base of that pyramid, it's pushing India's top IT firms towards more IP-led growth, focusing on intellectual property, specialized solutions rather than just, sheer volume of people doing basic tasks. For TCS specifically, they're not just focused on Gen AI, but also on agentic AI that can act autonomously towards a goal. These are genuinely new frontiers for growth. So analysts will be digging for details on how fast enterprises are really adopting Gen AI, any potential deflationary impact it might have on existing services, and crucially, those quantifiable numbers around their AI pipeline and actual revenue contribution. That's where, as you said, the rubber meets the road for AI's promise.
Right. And this workforce transformation naturally brings us to hiring trends in the wage hike cycle. These are always closely watched indicators of confidence, aren't they? What's the big picture for the sector's workforce, given all these AI-driven shifts and the cautious environment?
Well, the headline number is that the top 5 IT services majors are expected to add about 80,000 to 84,000 fresher jobs in FY26, which, sounds like a lot. However, there's caution baked in. Some companies like TechMahindra and HCLTech have been hesitant to give full-year numbers yet, citing that uncertain demand environment. HCLTech, for instance, said they plan to onboard about 2,000 freshers each quarter. It suggests a more measured wait-and-see approach.
Okay, a bit cautious overall. And what about the really big names? TCS, Infosys, Wipro. Are they still committing to large, fresher intakes?
They are, but with caveats. TCS is talking about over 42,000 freshers, Infosys maybe more than 20,000, Wipro around 10,000. But all these firms are stressing that they're watching the demand environment very closely to decide the final numbers. So again, caution is the watchword. And commentary on wage hikes and increments will be absolutely crucial this season. Remember, TCS made that significant move last quarter, delaying its appraisal cycle, which normally starts in April, that really underlined the macro challenges and the focus on cost control.
Right, I remember that. And didn't TCS also bring in a new HR policy? Something about making sure all associates are billed for a minimum number of days, like 225 days a year? That sounds like it's aimed squarely at reducing bench time, doesn't it? Getting more utilization out of everyone.
It absolutely is. It's all about maximizing utilization and efficiency, a direct response to those margin pressures we discussed. And it ties into the broader discussion analysts will be listening for, the ongoing evolving impact of AI on jobs within the sector. How will this leaner hourglass model affect their overall talent strategy moving forward? That's a key question.
So wrapping up this deep dive then, it feels like the Indian IT sector is really navigating this incredibly complex mix of, global uncertainties on one hand and massive technological transformation on the other. We've seen a pretty nuanced picture, haven't we? Some sectors and those midcaps showing resilience, while the larger players face some definite headwinds. And the promise of AI, it's clearly there, driving talks, driving pipelines, but its actual revenue impact, still mostly unquantified for many.
Yeah, and when we bring it back to the bigger picture, what this really shows you, the listener, is that while the immediate future for the big IT players might look cautious, there are these significant structural shifts happening underneath. It's not just about the next quarter's numbers. It's about how technology is being used differently, how companies are fundamentally adapting their strategies from the deals they chase to how they manage their talent. It's really a testament to their adaptability, I think, in the face of pretty unprecedented change.
Absolutely. Adaptability is key. And this whole discussion, it raises a really important question for you to think about maybe after this. Given this accelerating shift in the industry towards IP-led growth, towards specialized skills, and this radical reshaping of the workforce pyramid because of AI, what might the very definition of an IT job even look like, say, 5 years from now? And maybe more importantly, how should companies and how should individuals proactively prepare for a world where automation takes over more routine work, demanding entirely new skills and roles from the human workforce? Definitely something to chew on as this future continues to unfold rapidly.